Hello, everybody. Welcome back. In the last episode, we saw this is the analysis of Bajaj Auto. We we were able to see how, the in the income statement, what are the other expenses and things like that. So now let's go back and see what are things are left. So here I basically keep a snapshot of the income statement so that it's easy to go and look and refer to the footnotes. uh, Here we did see the different expenses were like employee benefit expense, other expenses, and we discussed about cost of raw materials. Now another very big thing is the taxes, right? So every company has to pay income tax to the government. So let's see uh, how it is for Bajaj Auto. Okay, so over here, if you look at it in this footnote, they have given how they figured out their tax responsibilities. So what I do is I usually go and look at this part. It's called reconciliation. So basically, uh, this is getting into a little bit accounting jugglery. Like when a company figures out taxes, there is sometimes deferred tax. Okay, this is because of the difference in depreciation. There's some timing differences between the taxing and the presentation of financial statements. But before that, what we need to see is what was exactly the tax it actually had to pay. So the tax rate is 34.6%, and the profit before tax is 5,900. If you do the math, it's about 2,000 crores of tax, like they are due. But then on top of this, they can make certain deductions. Okay, so when they made all these deductions and everything, it came out about 1,700. So now the question might be like what you should use when you are building your valuation model. Are you supposed to use this or that? What I would recommend is always use 34.6%. So first you figure out the revenues, the whatever the sales they do. You figure out the margin, so you get from that, that means how much percentage they have to pay to the for the raw material, the employee, other expenses. You take out all that, you get profit before tax, and then you put 34.6%. The reason I'm doing and trying to tell you is that all these other things they can keep varying. Okay, so 1 year they can get some kind of a break, like other year they might not. So the good thing is always to be in a conservative side, right? That's the philosophy. So you always put this rate, and you get a kind of a conservative answer for your valuation. So that is it from the income statement. So once you do that, so they finally, if you go down, the net income was about 4,200 crores. So you can say they had like a little bit increase from last year. Now, what about the return on equity? So return on equity is if you take net income and you divide it by the equity. That means this 20,000. So 4,000 divided by 20,000 is about 25%. That is a very good number. I'll tell you why. Because most of the times, if you see the large businesses, their return on equity is kind of less than 15%. So anything above 15 is good. But again, you can't take a blind rule because there might be sometimes some hidden reasons their return on equity is larger, and their business might not be that good, and vice versa. Return on equity actually might be less because of some one-time items, and but overall, if you see here, it looks pretty positive. So that's a good sign. Okay, so now let's move on and look at the next statement, that is the cash flow statement. Okay, so we looked at the balance sheet, we looked at the income statement, cash flow. In the cash flow, there are three categories: operating activities, investing activities, and financing activities. So in the operating activities, it means like from their main operations, how much cash they generated. That means whatever cash they got by selling the motor vehicles, and whatever cash they had to spend in all their expenses. So what is left is the cash they generated from operations. So this they usually do it before adjusting the assets and liabilities. That means before the changes in inventories and before the changes in payables, how much was it? So the company generated close to 5,000 crores in cash. So think about it. It's a cash cow. There are very few businesses in India that generate so much cash. Bajaj Auto is one of them. This again is this actually answers another fundamental thing. So if a company has a lot of has a really good margin. So again, like Bajaj Auto's margin is also good. So their sales was 25,000 crores and their net profit was around 4,000 crores. So that's close to about 17% net margin. Okay, that's a very good margin to have. Now, this only shows two things. Number one is they can demand higher prices for their product and customers still pay, right? That's how they make a big margin. So if you are not able to increase your price based on your costs, like more, your margins will not grow. Now, why are they able to do that? You can ask. Because they have a brand. So you can't just start like two-wheelers is such a kind of a business. You really need a good brand. So in India, the four big players are like Bajaj, Hero Motors, Bajaj Auto, TVS, and Eicher. For the Royal Enfield, Eicher is a kind of a new entrant in this figure. But why only four players? So it's like a pretty straightforward, right? I mean, you can kind of you know just get a shop and figure out you know your own design and name something like uh, let's say you can name as champion motorcycle, and I'm just making it up. Okay, you'll be a big failure because no one likes to buy a motorcycle which is not a brand name. So because of that, this is there is a higher barrier of entry. That means you really have to create a big brand awareness before even you can enter. So that's why you don't see a lot of new players popping up every day. These four dominant players are there. So this is always a philosophy that Buffett has always followed, is they have a big moat. He calls this as a moat. Moat means there's a big if you're sitting in an island, there is a big waterway around you and people can't reach you. So there is a big they have a huge advantage over any other new player because they have that name. So that gives them ability to keep generating more cash in future, and that keeps their business value intact. So you can predict for a longer term that they will be generating cash versus, let's say, any other business where anyone else can pop up. Like let's say trucking. In trucking, you will not see a very big name because it's very easy to enter. Like in trucking, you don't care. Like it can be like, hey, Singh and Company, or like let's say, uh, Tony and Company, any trucking company. You just hire them, you pay some price, and they deliver your products. I mean, I know Patel Roadways is there, but they could never become very big because it's like very much fragmented. So if a business industry is fragmented, that means there are many players. What it again means is it's very difficult to increase the prices. So I've not even looked at a trucking company. Sorry, I actually got a little sidetracked. So what I was trying to say is that I've not looked at any trucking company, but I can challenge you their margins will be way less than the auto manufacturers. It's because the competition is lot. They can't increase the prices, because of which they have to always keep low prices, and you know they're like barely surviving. So that's one fundamental thing I think we figured out. So now, after looking at all this, let's look at. So sorry, I lost chain of thought. So we figured out what was their cash flow from operations. Then they had little changes in assets and liabilities. That means they had decrease in loans and other assets, increase in liabilities and provisions, and So their net cash flow from operating activities, because of which it's shown as 6,000, but again it will vary because it is because of the changes in assets and liabilities. So I would say always consider operating cash, which is before working capital changes. Okay. Now, after this comes the cash flow from investing activities. Over here, the most important thing is the purchase of plant property and equipment. Now, look at this. This is a phenomenal number. So, any business where they have huge property and plant and equipment. Now, let's look at, like, in future, I'll be looking at any of Adani's business, like, like Adani Ports or, Adani like enterprises. He's a great businessman, no doubt, but his businesses, the economics are really tough. That means they have huge capital expenditures before even you can think of getting something. So they have to take a lot of loan, and they're in huge debt. That doesn't mean that they are not good businesses to invest in, but they have huge higher risk. So when you have a large capital expenditure, so you have to put on more cash before even you can think of getting back. So your risk increases. So over here, the company just has to spend about, around 200 crores every year, just so that they can keep upgrading their factories and all. And guess what? They keep getting almost 5,000 crores of operating cash. So their free cash flow, so let us do the quick math here, is 1 minute. Where did it go? Is about, so 4,900 crores, right? This much minus 200 is 4,700 crores. So think about it. That's something every year the company is generating. Every year. So plus they already have that one. So this, what this means is they can pay dividends, they can reinvest whatever. But thankfully they're not reinvesting in some other bad businesses, but they're constantly every year about 4,700 right now, this rate. So even if, let's say, they increase by 5%, so you can think about it like, even in like 10 years down the line, it will be 10,000 crores. Uh, so that's the, very beauty of a great business that has a good cash flow, steady cash flow, and which is, not having a lot of competition. So that's a really good part. So we looked at the investing activities. Now, other than that, there are also, you ask what are the investments. So again, these are like, they buy money market funds, and they sell and all those things. This is not that alarming, but when it comes to, let's say, you're analyzing a banking company or any other financial company, you have to dig in deeper, like, what kind of investment they are buying. I'm pretty sure here they are buying very high grade investments where the chances of losses are very less. They're pretty secure. Now, other than that, there is not much to look at in the investing activities. The third one is the financing activities. So here, like, literally, they don't have anything a lot at all, because they paid a good dividend for about 1,600 crores, and their interest was like really not even 1 crore, so because they have very less debt. So this is overall. So we saw income statement, balance sheet, cash flow statement. We have figured out, the different, like, we looked at the different footnotes that are important, that we have to, make sure they're part of this thing. So one last thing we can quickly look is a segment info. Let's go down. That's footnote 35. So here, if you look at so this only shows geographic segment. That means, how much revenue they got in India versus the rest of the world. So this is something you always have to keep in mind, because the rest of the world means it includes Africa, South America, and all. So you have to be a little bit skeptical. So even though the growth might be good there, but because of the foreign currency, risk of devaluation, this part you might have to value a little bit more concern.